We're now almost 6.5% off that intraday low on the S&P. The Nasdaq's up almost 11% on that intraday and the lows of the SVB crisis. So there's a bull market in your bear market, and I think that's part of the story here. We've seen that also the buy the dip mentality.
Where we're going to see new lows.
I think the market has to price in earnings contraction. I think the market has to price in credit widening. I think the market has to price liquidity dynamics. But as we've said for a long time, I think on the show collectively, this is a cycle that does not play out overnight. And I think there are many phases of a bull market that we're going to go through. But there have been many phases to trade from the long side. And the market right now, the bears should say appropriately, the fact that this buy the dip mentality is in this market is something that probably should scare people.
You know what is pricing in all those things that you said, the S&P and the Nasdaq should be the Russell 2000 small caps. They're flat on the quarter. And I think that's really notable here when you think about all those things that you just mentioned about, like, the cost of money and access to credit and all those sorts of things that could lead to a slowdown in our economy at some point this year. The Russell 2000 is telling you a little bit that is very much on their bingo card if you invest in small caps. And so
it also has a lot of banks in the Russell.
Sure.
And they're down sharply.
Yeah. And so does the S&P. I mean, what I'm saying is like, a lot of the stocks in the Nasdaq have exposure to the financial sector, right? And so when I look at the Nasdaq and I look at, Nvidia up 87%, I look Apple up 25%, I look Microsoft up nearly 20%, Amazon up nearly 20%, Meta up 75%. That's not particularly sustainable, and that's not suggesting that there's any fear in the market. But when I look at what's gone on in regional banks, I look at what's gone on in the XLF, I look at what's gone on in the Russell 2000, there is fear being priced in there. And I'll tell you where there's fear being priced in is that MOVE index. I just saw Michael Santoli talking about the spread between the VIX and the MOVE, which is, measuring the volatility in the Treasury market. So to me, I think that stuff is a bit of a mirage. It doesn't make a whole heck of a lot of sense to me. It's not sustainable.
Lots more volatility in the bond market than the equity market is the bottom line. So, Guy, I mean, you can make an argument that when it comes to what's working now, it's safe tech. Mm-hmm. It's better balance sheet tech. The ARK Innovation Fund went down today. It's down for the month of March. This is not like all tech.
Tim's been on this. As long as the Nasdaq, those stocks specifically, continue to grind higher, it's very hard for the broader market to go down. That's playing out right before our very eyes. There is perceived safety in those names, which I totally get. Their balance sheets are juggernauts. But you know what? Right before our very eyes, a lot of those stocks have gotten expensive again. Microsoft just got expensive again. I know Apple's the greatest company in the history of mankind. It's expensive in this environment. There are a lot of things that don't make sense to me. And below the surface, Dan mentioned the MOVE index. This is a 15-year level. Last time we saw the MOVE index over the VIX at these levels was in 08-09. Not making that comparison, just pointing out the last time it happened. The gold market is telling a story. Dollar is now backing up. That's telling a story. So there are a lot of things to be concerned about, not least of which the lag effect of 9 months of Fed rate hikes, to me, hasn't kicked in yet at all.
So you're not buying it, are you, Karen?
I'm always long, so I guess you would, I always say...
Are you adding?
Am I adding? No, I haven't really added. I bought a little bit of URI, which got crushed in the last month. It went from a high, I think it's maybe down, I don't know, $90, which seemed overdone to me. But I don't know what to make of this action post the SVB crisis, because it's a pretty big crisis, I think, because of the potential for contagion. And so I'm surprised that the market has come back as well as it has. I'm really interested to see what do banks have to say? What does J.P. Morgan have to say about this? What do they think is happening in the economy? What's happening in lending? That's going to be really important. What's happening in credit, which hasn't been the problem. It's only been duration risk. And then what are they doing with all the deposits? And what's going to happen to the regional banks? What's the business model?